That's right. I'm here with Bob Shiller. And again, let me just explain a little bit about the conference that's going on today. It's a lot of heavy hitters and researchers in the ETF and in the indexing industry here to talk about the latest trends. And here with me, the keynote speaker from today's luncheon. He's going to talk in just a little bit to those folks is Bob Shiller. He's the co-creator of the CaseShiller Index. He is also chief economist and co-founder of MacroMarkets, and he's co-author of Animal Spirits: How Human Psychology Drives the Economy and Why It Matters for Global Capitalism. Bob, thank you so much for joining us. Appreciate
Julia, pleasure to be here.
So, speaking of animal spirits and market psychology and economic psychology, we just heard Dom talking a little bit about the retail sales numbers today and that people may be saving right now rather than spending their money. Why do you think that's happening when, payrolls notwithstanding, some of the other economic numbers have looked pretty strong?
Well, the saving rate in the United States, personal saving rate, has been declining since the early 1980s. We used to save 10% of our income. It got down to 0 or negative. And so I think we were in an abnormal state. And it wouldn't surprise me if we returned to something more like a normal saving rate. And I think that would be a good thing in the long run, maybe not in the short run.
In the short run, it might mean more of constraints on retail sales, for example.
The short-run fear is that it will be a depressant on the economy. We would like to see people save more and businesses to invest more, but that might not be happening. And so that's the Keynesian dilemma, that if they don't want to invest more and everyone wants to save more, it puts us in a downward spiral.
Well, speaking of a downward spiral, as you well know, there's been a debate recently about the possibility for a double-dip recession, whether you're talking about the broader economy or just in housing, for example. And you wrote a column in the New York Times several weeks ago, and you said a double-dip recession could be sort of a self-fulfilling prophecy. Right. Explain what you mean exactly.
Well, a self-fulfilling prophecy, as I was just saying, and you mentioned my book, Animal Spirits. We think that economists have not appreciated the magnitude of the impact of confidence on the economy. It's the major driver of the economy, we believe. And we have to think about what moves that. So anything that, we just went through a Great Depression scare. That was a real scare. We were thinking it's coming again. And the Fed and the government took on extraordinary measures to prevent that. So maybe we're back, but I think our confidence is still vulnerable. And
so do you think there will be a double dip?
Well, I have my own definition of a double dip, which is another recession, maybe not right away, but before we get back to a completely normal economy. I think there is a significant possibility of that.
And you're talking about a longer time horizon here, though, in which it could happen. I mean, are we talking a couple years, 5 years? What kind of?
Well, the thing is that having a new recession, presumably the recession that began in 2007 ended in 2009, although the NBER has not announced the end yet. So if we were to have another downturn right now, it would be very unusual. We still have some upward momentum, but it could come in a couple of quarters, or it could drag out for years.
Well, what is all of this going to mean for the markets? Is this going to mean that we can't gain any significant traction, or that perhaps stocks are going to go up and then get taken off guard by something like what you're talking about?
Well, first thing, it's hard to predict markets. And so you're asking me to take my shot at it. I find it a hard time to predict the markets because they're not particularly high, not extremely high. Both the housing market and the stock market have come down to within the range of normal levels. So, you can't base it just on overpricing. And then we're in this very questionable economy. I would have to say that I'm just torn. I don't know. And I think, though, that there is a significant risk of further declines in both the stock market and the housing market.
Well, I just wanted to pick up on the housing market theme because you're here for an ETF and indexing conference, CaseShiller Index, which you are going to be developing once again, an ETF that is linked to that. So where do you think that index is going to go? There are some people who have called for, yes, that to last a little bit longer, but then slowly stabilize and begin a rebound.
Well, my company, MacroMarkets, does a survey of professional forecasters. And these forecasters are predicting kind of stable prices for the rest of this year in the housing market, and then an increase a couple percent a year, accumulating to about 12% increase by 2014. That's the consensus forecast. That's not, that basically says that real values are constant, because not much change. I think I might be a little less optimistic than that. I would be among the more pessimistic of these forecasters, but there doesn't seem to be a forecast of disaster that is prominent.
Right. Okay, Bob Shiller, thank you so much. And one of his credentials I forgot to mention, Yale University, a little one.
Don't mention.
Don't want to leave that one out.